Hi, I'm Fred with Boathouse Commercial Funding Group, and I'm here today to tell you that the drop in rates is going to be the worst thing that ever happened to property investors.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 458. As we're recording this, the Federal Reserve is scheduled to meet over the next week, and by all accounts, they are expected to lower interest rates for the first time in over 4 years. But are lower rates good for real estate investors? My guest today would argue no, and he's here to tell us why. Fred SaintAmour is a former U.S. Army Ranger who now helps real estate investors and business owners of all sizes get the capital they need when they need it with the best terms possible. Fred has been a commercial loan executive with Boathouse Commercial Funding Group since 2010. Fred, welcome back to the show.
Thanks, Brian. Glad to be here.
Always good to get your opinion on what is going on with the market, the lending environment, interest rates, things like that. And we're at a really kind of crucial, pivotal time right now with the Federal Reserve. I mean, it's as we record this, it's September 12th. I think it's September 17th. They're expected to lower the rates for the first time in 4 years. Some think it might be a 0.25%. Some think it might be 0.5%. I mean, what's your take on that? Are people crazy? Do you think that's going to happen? And what do you think the fallout's going to be?
I think it's going to happen. And kind of the premise of the show is like, for real estate investors, that's not always the best thing that could happen to them is lower rates. We have a bunch of clients or contacts who are, they're kind of sitting on their hands waiting for interest rates to drop. But when they do, a lot of other players are going to enter the market. There's a couple of stats I looked up. In the 1970s, 7% of 25 to 35-year-olds were living with their parents. Fast forward to 2024, and 17% of 25 to 35-year-olds are living with their parents. And they're waiting, just like you're waiting, or investors are waiting, or some investors are waiting, for rates to come down in order to buy, in order to qualify. And then this is according to the National Association of Realtors, for every 1% drop in interest rate, that's another 5 million people who can qualify for a mortgage. And that doesn't take into consideration the 65-year-old, 70-year-old homeowner with a $400,000 mortgage trying to downsize to maybe a $250,000 mortgage. Right now their mortgage is at 3%. And, they can get a new mortgage for 7%, but the payment's the same. So they're saying, why should I move out of my big house to a little house and have the same payment? Right. And so we're seeing that. So that 5 million new buyers, that's only first-time home buyers. You add in the older people who are trying to downsize. You add in these government incentives, $25,000 gift down payments so people can buy and afford houses. Those are catching steam. And that was part of the presidential race programs. But that's even more people looking to buy starter homes. And then, the border's still kind of wide open and people are still coming in and they all need houses to live. And, we already have a housing shortage. And so that's driving up prices. So the interest rates coming down, it's just going to increase in investors' competition versus decrease it.
What I'm hearing you say is that the high rates have created a barrier that has prevented a lot of first-time homeowners from buying properties, prevented long-time homeowners from downscaling to smaller properties. And the savvy investor shouldn't worry so much about the higher interest rates because they have more options available to them. What are you seeing right now? Are you seeing real estate investors taking advantage of this lack of competition?
My investors who are very, very active right now, so yes, they have the mindset, it's called marry the house, but date the rate. And so I have a couple of scenarios I'll spell out, and hopefully you can kind of follow along. But let's take another example. Let's say you have $80,000 for a down payment, but you're not jumping into the market until rates are back down at 6%. And why 6%? Because it's a good rate, right? I'm doing air quotes. It's a good rate. But compared to what, right? Compared to 7%? Okay, it's 6% is better than 7%, right? But let's see what happens when an investor buys that $400,000 house with their $80,000 down payment at 7% instead of waiting for it to go to 6%. The difference on a $320,000 mortgage between 6% interest rate and 7% interest rate is $210. Okay. And he buys that house for, $400,000 house. He buys it at 7%. So he's overpaying by not waiting $210 a month, which for, 24 months, that's $5,000 extra he would have paid in interest.
So $2,500 more a year to take on the higher interest rate, but also be able to take down a house.
Take down the house. And that $400,000 house has been appreciating, 5% a year for the last, since 2019. And so that $400,000 house in year one is worth $420,000. And that $400,000 house in year two, plus, 420 plus another 5% is worth $441,000. So you subtract out the $5,000 extra, on the balance sheet, the extra that he paid in interest, and he's way ahead, and he owns the asset. Meanwhile, the investor who didn't take his $80,000 and buy the house, that $80,000 now with inflation is worth how much, right?
Well, maybe he was getting 3 or 4% in the money market,
right? And then if he's going to buy that same house, he's got his $80,000 down payment, but now he needs another $4,000 to buy that same house 2 years later, right? So in the way the market is depreciating, and I'm in Michigan, so it's been going up 10%, but I'm using the national average from the National Association of Realtors of 5%. So the numbers could even be more favorable, granted less favorable depending where you are in the country. But sitting on the sidelines waiting for the rates to drop doesn't really make financial sense in most areas of the country.
I think you summed it up pretty well mathematically. I mean, if you're getting hung up on 1 or 2 more points in interest, you're overlooking the fact that just the gain in appreciation that you'll get over that period of time more than offsets what you'll be paying in interest. Now, that is more money coming out of your pocket in the year 1, 2, or whatever. But at some point, as rates go down, you can always go back and refinance.
Yep, you gain $41,000 on paper, right, in equity. You minus the $5,000 you paid in interest expenses. You minus the $10,000 to refinance from 7 to 6 and the refinance costs, and you're still $26,000 ahead.
And you probably lowered your monthly payment too once you get to that point where you do refinance.
Absolutely.
What are you seeing buyers do in preparation for that idea? Like, hey, I'm going to pay now the higher interest rate, but I know that in 2 or 3 years, or I believe in 2 or 3 years, rates will come back down and I'll refinance at the same time. How does one protect themselves from having a high prepayment penalty? Do you take that into account up front so that you can minimize what that prepayment penalty is going to be?
You have options for different prepayment penalties. And there's an inverse relationship between the length of the prepayment penalty and the interest rate. So the longer the prepayment penalty, the lower the interest rate. So let's call it a 5-year declining prepayment penalty would be 5% the first year, 4% the second, 3% the third, all the way down to 0. But there's also, and so say the interest rate on that's 7%. Well, if you want a 3-year prepay, declining prepay, it's 3% the first year, 2% the second, 1%, and then 0. And that rate might be 7.2. And then there's a 1-year prepayment penalty, which is 3% the first year and then 0. And that rate might be 7.35, somewhere in there.
You're going to pay a premium on your interest rate, but it gives you the ability to turn around and refinance in a year or two without having the prepayment. When you look at it, it might well be worth paying that extra higher interest rate.
Yeah, right now I would say so. 4 years ago, people were getting 5-year prepayment penalties. Now most of my loans I'm doing the borrower elects a 3-year.
Now, is all that negotiable? And do people realize it's negotiable, or do they need to bring it up with you or their lender to say, hey, I'm really concerned about my prepayment. What are my options?
There's options, at least with me and how we fund loans. Maybe if you're at a bank, maybe they have rules that, this is the prepayment penalty that the borrower gets. But definitely bring it up in conversation.
What about buy downs? I mean, that's something that maybe some of our listeners aren't familiar with, is the option of buying down your rate if you want to just keep it fixed for a while.
So we do buy downs more so for homeowners or consumers to help them qualify or take they're trying to buy the biggest house they can. It may be pressed up against their debt ratio. So we might buy the rate down to help their debt ratio and help them budget more effectively. And for commercial loans and real estate investors, you're either paying 2 points to buy the rate down, or you're paying 2 points on the exit if you're going to refinance. So it's kind of a wash.
So Fred, you work with both people who are buying homes and you work with investors who are buying investment property. What are you noticing are the different ways that they approach looking at the numbers and the interest rate situation? For
the real estate investors who are listening to this, and maybe they're new, maybe they're seasoned too, the investors that I see that are most successful is they stopped thinking like a homeowner and they started thinking like a real estate investor. I was going back and forth with this new investor, and he's like, well, and it's $100,000 loan, and it's his first one. And he's going back and forth and checking with me every day to see if the rates change, right? And, finally I said, on a $100,000 mortgage, if the rates go from 7.25% to 7%, it saves you $17 a month. Like, drink cheaper wine, if you want to say $17 a month. But it was an everyday obsession with them. In homeowners, the homeowner's mindset, and this comes because of, the cocktail party. And Franz says, Franz has a 2.75% interest rate. And he asks you what your interest rate is. And you're like, well, I'm at 3. And Franz is like, what did you do wrong, old boy? When Franz has...
Those are exactly the cocktail parties I go to, by the way.
Yes, right. But Franz has $80,000 in credit card debt, and he owes $500,000 on a $600,000 house, and you owe $100,000 on a $600,000 house. But Franz got you because he's got 2.75. So I remember this is where it kind of dawned on me. It was maybe a year and a half ago. One of my investors called me up and said, Fred, what are rates right now? And I said, 8.5. And he said, what? And I said, well, the Fed's meeting and we have unemployment numbers coming out and they're trying to soften that against inflation. And he's like, no, I just didn't hear you. And I'm like, oh, 8.5. He says, hold on. Okay, I'm buying the house and you can refinance and pull 80% cash out next week, right? And I'm like, yeah, I can do that. So he didn't really care he just needed to know what the interest rate was so he could put it in his formula to see if he wanted to buy the house, right?
Yeah, don't get hung up on interest rates. It's just one term that really it might not even have a significant effect on the outcome of the property that you're investing in. I mean, what are the terms that people really should be looking at right now?
I had a client, he had a really unique house that he was rehabbing. And then he had another house he owned free and clear. you need to pull 75,000 out to rehab it, right? And I'm doing my little calculations, and we'll talk about that more later, my debt service calculations on a single family rental. And I put, I'll put $1,200 in for taxes, and I'll put $800 in for insurance just to get my rough numbers. That house was in a downtown, and the taxes were $2,500 a month, which is $100 more a month than I thought. Right? But people go in and they're buying an investment property and they're worried about 7 and 7.25, which will save you, $17 a month. But ignoring the taxes, like what are the taxes here versus the county or the city next door, right? Right across property lines. So that's the one I see a lot of people being shocked when, they want to buy a 5-unit versus a 4-unit. Or a 6-unit or an 8-unit. But the insurance on a 6-unit or a 5-unit compared to a 4-unit, you think it'd go up incrementally by doors, but it doesn't. Insurance has increased dramatically on commercial properties, and so have the taxes. So, what's better, Brian, having 2 4-units on separate parcels, or having an 8-unit? And that's just a really interesting analysis when you factor in not just the interest rate, but you factor in the taxes and the insurance. And again, you have to factor in appreciation too. So
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. The difference there would be the 2 4-units, which are residential versus an 8-unit, which is commercial. Are you saying you've seen commercial insurance rates go up faster or higher than residential insurance rates?
Yep. Especially on older buildings, because older buildings now they have to go with replacement cost and you can't build them. These $200,000, $500,000, 5 or 6 units, they cost $1 million to build now. So now you're insuring it for $1 million. So yeah, it's gone up quite a bit, shockingly.
Those are good points. And now let me just repeat them because I think it bears repeating. One is property tax. Here in Michigan, when you buy a property, that property tax uncaps. So you have to make sure you know what your actual property tax is going to be. That can really affect what you're able to pay. The other is insurance, which used to be relatively, just another line item on your expense sheet. But now it actually can be a deal killer because I've seen insurance rates on some of my larger properties go from $80,000 a year, and these are large apartment complexes, to when a buyer was looking to buy it, over $190,000 a year. So, I mean, that's a huge increase that really affects what someone is able to pay. So you're right. Interest rates are just one piece of the equation. You have to look at all the other expenses too.
The interest rates might be the smallest part of the equation.
Yeah, I'm starting to realize that from this conversation. So talk about the terms of the loan, though. I mean, you've got your, is there a balloon payment? Can you get interest only? What are some of the things that people should be negotiating when they look at these loans that they're taking out on investment properties?
One thing I would look for, because no one knows the future, right? I like 30-year fixed. Now, we're starting to see ARMs again, but an adjustable rate mortgage, it might save you 10 basis points, which is instead of 7%, it might be 7.1%, right? But I would stick with the 30-year fixed. I would kind of hedge my bet against, rates, which hedges your bet against rates going up. And then go with, a moderate prepay, take advantage of a little bit lower rate and a shorter term prepay. I'd look at those terms. And other things I look at too, which is interesting. So, 3-4 years ago, there was a bunch of loan officers, offering 2.75% rates, right? And I call this my puppy dog salesman, and they'd say, Hey, Mom, I'm sure good at selling puppies, right? And look, I'm sure I'm selling a whole bunch of them, and then the rates, then the puppies become dogs, and then how good are you at selling it? So, selling 2.75 was easy. Surviving the mortgage business when rates were at 8, that's a lot tougher. Right? Does that make sense?
Are you saying that a lot of these lenders who were there during the super low interest rate environment are no longer around because they don't know how to survive when interest rates have climbed sky high?
It's easy to sell a puppy. It's tough to sell a dog, right? And so, but, buying a dog might make sense. So in that example, does it make sense when you have a 3% loan on 100,000 on a house worth 500? Does it make sense to save that 3%? So when you have that conversation with Franz, you're at 3% and not at 6 or 7%. But meanwhile, all that equity is tied up and not being used. It's just sitting there. It's dead space. So that's another factor to consider, is how much equity you have and how can you put it into play, and what's that equity doing for you?
If someone listening has equity in a property, whether it's their home or a rental property, how would they access that equity? What are the options? There's
a couple options. So everyone knows about like Fannie and Freddie, right? Fannie and Freddie mortgages, they're conventional mortgages. They look at your tax returns, your W-2s, your pay stubs, and those are fine and okay. They serve a purpose for home buyer. But as soon as you get into investing, you get your first mortgage on your primary, you get your second mortgage on your first investment property, you get your third mortgage. These are all reporting on your credit report. By the time you get your fourth mortgage, your fourth investment property, your beautiful 780 score is a 640. Because FICO looks at it and says, this guy has too much debt and they're all maxed out. So I would ask, another thing I would ask is, first off, do you do a hard credit pull? And the second thing I'd ask is, are you going to report on my personal credit report? You get all these mortgages on your personal credit report, and they're not in LLCs. These mortgages aren't in LLCs. It's going to mess up your debt ratio. If you do decide to buy another primary residence, Freddie's going to say, oh, geez, with all these mortgages, you don't qualify. And I look at your tax returns, you wrote too much, you wrote too much off. So you can't afford this new primary residence. So, and we have solutions for that too. So I'd look at that. Is this mortgage to buy an investment property, and I'm using my LLC to do it? Is it going to report on my personal credit report? Why would it? The loan is made to an LLC, right? And that's what, our loans are commercial loans. They're made to LLCs. We do a soft pull. We don't report to your credit report because it's your personal credit report, and this loan is to your LLC. So that's some of the terms I'd look at as well.
Fred, did we cover the things you wanted to cover in this conversation?
I wanted to cover one more.
Please, go ahead.
I have a lot of borrowers that they have free and clear properties, right? And that house, let's say, and this is a real example, it's worth $400,000, and they own it free and clear, and they have the money coming in, and it's nice, it's great cash flow. but it was a married couple and one spouse didn't want to go ahead with it, one did. But, take 20%, take 50% loan to value out of house one to buy house two, and you factor in all your charges and closing cost of 10 grand maybe each, and additional taxes because now you have two properties, additional insurance because you have two properties. But I'll put it in, we discussed about the formula and kind of the spreadsheet that maybe you can put in the description, where in 2 years, the borrower who took 50% out of their $400,000 free and clear house and bought another house is $50,000 ahead just in 2 years with 5% appreciation. So, but the equity's still the same though, Brian, right? You still got 20,000 equity in this house and 20,000 in that house. You still have the same equity, but you have two appreciating assets instead of one.
You're making a strong argument to tap into that equity that you have in your free and clear properties.
And maybe you're waiting for the interest rates to go down to do so. But again, we've already had that discussion too.
Hopefully that's one big takeaway is don't wait for the interest rates to go down. Just do it, because once the interest rates go down, the competition is going to be through the roof. And the interest rate doesn't really bend the needle that much.
Marry the house, date the rate, and stop thinking like a homeowner. When we bought our first house, right? All we cared about was the rate. So think like a real estate investor.
Fred, how would people find out more about you, get a hold of you, learn more about Boathouse?
Well, our website's a great place to start, and that's Boathouse, just like you'd think it's spelled, and then CFG for Commercial Funding Group, BoatHouseCFG.com. My email address, I'll give you my direct email address. That's Fred, F-R-E-D, at BoatHouseCFG.com. And if you prefer a phone call, it's our office number is 269-459-2530.
Fred, what is your favorite hack or app?
It's called App Block. So every morning at 7:30 in the morning, YouTube is blocked, Twitter's blocked, Reddit's blocked. I block a whole bunch of distraction apps, and it doesn't unblock till 7:30 at night. And so I'll go to like Google something, or I'll go to like look something up online. I'm like, oh, there's a video on it. I click, and it's like, no, you don't get to, you don't get to do it. It's called App Block, and it's like forced self-discipline that I use, because without it, I could look down at my phone. Oh, I got a text. Oh, I got an alert from, Twitter. Oh my gosh. And then it's 20 minutes later and I'm still on Twitter, right? Or Facebook. Facebook's also blocked. So that's probably my favorite app to hack my life.
And it's called App Block.
App Block. APP Block. Yep.
Fred, thanks for coming back on the show and talking about interest rates. Marry the house, date the rate, stop thinking like a homeowner. Those are great words of advice. Thank you so much for coming on the show and sharing them with us today.
Hey, I appreciate it, Brian. It's always a pleasure, sir.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.